Welcome to the Research Desk. We are bypassing the pleasantries today because the intelligence briefing in front of us demands immediate, unhedged attention. We're looking at a highly concentrated and incredibly dense deck titled AI, Market Timing, and Concentrated Returns, Alpha or Annihilation. The premise here is to deconstruct this intelligence and map out exactly how artificial intelligence is rewriting the fundamental laws of market physics.
Right, and the central conflict driving this entire briefing really comes down to one critical question. Is artificial intelligence refining market timing into an instrument of high precision alpha, or is it acting as an accelerant for unprecedented systemic fragility?
Yeah.
Because we're looking at a paradigm shift where the nature of time, liquidity, and risk, they've just been completely altered.
Let's unpack that, starting directly with the concept of time, because time as we know it in the markets has effectively collapsed. For decades, traditional wealth management relied on a very specific historical rule.
The J.P. Morgan research.
Exactly. The briefing cites that J.P. Morgan data. It lays out a stark reality. If you miss the 10 best trading days in the market over a decade, your long-term returns are essentially halved.
Right.
And conversely, if you somehow manage to avoid the 10 worst days, your returns double.
But here is the critical detail that makes that rule so unforgiving for you as an investor. Historically, 7 of those 10 best days, they cluster within just 2 weeks of the 10 worst days.
Yeah, the volatility is tightly packed.
Extremely tightly packed. You have a massive sell-off, panic sets in, and then a few days later, a massive relief rally.
Right, but according to this intelligence we're looking at, that 2-week window of chaos, that fortnight, it's gone.
It has been violently compressed. In this AI quant era, these massive market-moving volatility events have collapsed from a scale of days into mere minutes.
That's unbelievable.
The extreme swings that used to play out over 2 turbulent weeks are now executed in the time it takes you to walk to the kitchen and pour a cup of coffee. And this compression, it permanently alters the baseline requirements for your portfolio's resilience. I mean, if the event happens in 3 minutes, human reaction time is entirely removed from the equation.
Which the briefing backs up with some staggering academic research on slide 3. It confirms that algorithmic trading has driven a 400% increase in what they call information incorporation speed since the 2010s.
Right.
A 400% acceleration is massive, but let's pause for a second, because information incorporation speed sounds like academic jargon.
Right.
What does that actually look like for the person listening to this right now?
Think of it as price discovery. Price discovery is just the process by which the market decides what an asset is actually worth based on new information.
Like an earnings report or...
An earnings report, an employment number, a central bank announcement, exactly. In the past, human traders would read the news, synthesize the data, call their brokers, and the price of a stock would adjust over a few hours, sometimes even days.
Yeah.
Today, AI models scrape the data, interpret the sentiment, and execute thousands of trades before a human analyst has even finished reading the headline. The price is discovered, and the opportunity is gone in microscopic timeframes.
So that old top 10 days rule we just talked about.
It has been forcefully and irreversibly replaced by the top 10 minutes rule. Your portfolio's success or failure over a decade might legitimately be decided by how it is positioned during a handful of 60-second windows.
That is terrifying.
Yeah.
And that brings us to slide 4, the regime shift matrix. The core differences between the traditional era and the AI era. The time frame has obviously shifted from months and days down to microseconds and milliseconds. But the decision engine has completely changed too. The briefing notes, we've moved from human intuition to GPU inference and reinforcement learning. Can we do a translation on that?
Absolutely. So in the traditional era, you had a human portfolio manager reading balance sheets and using their intuition to forecast a company's future. Today, the decision engine is a graphics processing unit, a GPU. It's essentially a super-powered calculator that can process massive parallel streams of data instantly.
Right, the hardware advantage.
Exactly. And inference simply means the AI is taking new live data and running it through a pre-trained model to make a prediction. It's not forecasting a year out. It is predicting what the stock will do in the next 3 milliseconds based on historical patterns.
And risk management has fundamentally changed alongside that. The briefing argues that static stop losses are dead, completely replaced by order book liquidity adjusted stops.
Right. Under the old regime, you used a static stop loss. You tell your broker, if this stock drops by 10%, sell my shares automatically.
Set it and forget it.
Exactly. But today, risk management for institutional AI is dynamic. It calculates the exact depth of the market, meaning exactly how many buyers and sellers are currently active at different price points before it even executes an exit.
The overarching strategy paradigm here really sums up this entire shift. We used to live by buy and hold. Now the mandate is compute and harvest. It sounds less like investing and more like industrial farming.
Compute and harvest is the perfect description. It is no longer about predicting a long-term economic trend. It's about having the sheer computational power to harvest mathematical inefficiencies the absolute millisecond they appear in the market.
So let's look at the bull case here on slides 5 and 6. The argument that AI is turning market timing from a guessing game into a high-precision industrial process. The briefing introduces a really surprising wildcard analogy that I love, the woke of alpha.
Yes.
For anyone who loves cooking, woke translates roughly to the breath of the woke. It's that incredible smoky flavor you get when a master chef uses extreme heat to flash sear ingredients. But how on earth does stir-fry connect to algorithmic trading?
It connects through the necessity of extreme conditions. To get woke in a kitchen, you need blazing volatile fire.
Right.
To get this specific type of high-frequency alpha in the markets, you need extreme volatility. The AI models use a strategy called reinforcement learning for mean reversion arbitrage.
Let's break that down for those of us who aren't quantitative analysts.
Sure. Mean reversion is just the mathematical gravity of the market. It's the idea that if a price swings wildly away from its historical average, it will eventually snap back to that average.
Okay.
And arbitrage is making a risk-free profit on a price discrepancy. So during a moment of massive panic, when prices are swinging violently, these AI models flash sear the market. They capture what the briefing calls tail day alpha right before the opportunity evaporates.
And the briefing brings up the 2010 flash crash as the ultimate historical context for this. During that event, the market dropped nearly 9% in a matter of minutes.
The 2010 flash crash is the perfect case study to understand the stakes here. During an event like that, legacy systems, the older, slower algorithms and traditional human-managed funds, they enter a panic sell zone.
Because they hit their thresholds.
Right. They are programmed to automatically liquidate when certain risk thresholds are breached. This creates a cascade of chaos, driving the price down further and further.
But the modern AI models are trained to do the exact opposite, right?
They are. They don't panic. They are mathematically trained to find the exact bottom during these 60-second crashes. While everyone else is forced to sell, these models step in as the buyer of last resort.
They harvest the liquidity gap alpha.
Exactly. They buy your shares at a massive discount, and when the panic subsides 3 minutes later and the price mean reverts back to normal, they've locked in a tremendous profit at your expense.
That sounds incredibly lucrative if you possess the computational power to execute it. But the briefing pivots sharply into the bear case on slides 7 and 8. And this is where it issues a massive warning about what it calls the liquidity mirage.
This is critical.
The argument is that as AI models cluster all these trades into minutes, they stop discovering prices and start creating them.
Right, and this is where we shift from high-precision alpha to unprecedented systemic fragility. The briefing breaks down a terrifying mechanic called the epistemic feedback loop.
Walk us through how that loop actually operates in practice.
It starts with historical data inputs. Because all these institutional AI models are looking at the exact same data sets and are trained on very similar reinforcement learning parameters, they frequently arrive at the exact same conclusion at the exact same millisecond.
Meaning they all decide to execute the same trade simultaneously.
Yes.
Which means it's no longer price discovery. It is forced price creation.
That's the danger. This simultaneous execution leads directly to correlation spikes. Everything moves together. That creates a liquidity vacuum. Suddenly, in a matter of microseconds, there are absolutely no buyers, only a wall of algorithms trying to sell.
Which culminates directly in a systemic flash crash.
Exactly.
The briefing explicitly calls this the epistemic arrogance of models. The idea that treating financial markets like sterile physics equations completely ignores human reflexivity. And it highlights some staggering historical failures to prove the point. It notes that Isaac Newton, literally one of the smartest humans to ever live, lost millions in the 1720 South Sea bubble.
Right.
He could calculate the motions of the heavenly bodies, but he couldn't calculate the madness of crowds.
And we see that same historical arrogance repeated in modern quantitative finance. The briefing heavily emphasizes the 1998 collapse of long-term capital management, or LTCM.
Oh, yes.
This was a hedge fund run by Nobel laureates. They had the smartest mathematical models in the room, but they suffered a 10 sigma collapse.
And a 10-sig event is basically a statistical anomaly so rare it shouldn't happen in the lifespan of the universe, right?
In a sterile physics environment, yes, but markets aren't sterile. LTCM's models relied heavily on historical data, but completely failed to account for how the sheer act of their own trading fundamentally altered market reality.
Because they were so large.
Right. When they needed to exit their massive positions, the liquidity they mathematically assumed would be there had just vanished. Why? Because the rest of the market knew they were in trouble and backed away.
And we see this play out today. The briefing points to the modern Accenture flash crash. Imagine logging into your brokerage account, and Accenture, a massive, globally dominant tech consulting firm, is suddenly priced at one single penny because an algorithm lacked common sense.
It perfectly illustrates the stark warning the briefing provides. Speed without a fundamental valuation anchor is mathematically just a faster methodology for reaching zero.
Wow.
If an algorithm doesn't know why a company is fundamentally worth what it's worth, if it is only looking at order flow and price momentum, it will confidently sell a blue-chip stock all the way down to a penny.
Oh.
It has unimaginable speed, but absolutely no compass.
So how do we reconcile these two realities? The briefing synthesizes this on slide 9 into a taxonomy of accelerated markets. It argues that the flash alpha opportunity and the systemic tail risk are exactly the same phenomenon. They are two sides of the same coin, just viewed from different positions in the liquidity stack.
This is a crucial concept for you, the listener, to grasp. For high-frequency algorithmic firms that possess sub-microsecond infrastructure, these highly compressed volatility events are a highly harvestable asset. They're the ones catching the knife at the bottom and making a fortune.
But for everyone else, what does this mean for a retail investor or a pension fund managing retirement money?
For them, those exact same minutes are a liquidation trap. The speed of ruin and the speed of opportunity share the exact same velocity.
That's a sobering thought.
If you are relying on traditional, slower mechanics, your static stop loss is triggered, your position is sold at the absolute bottom of a flash crash to an AI firm, and minutes later, the market recovers. You are left with permanently locked-in losses while the AI firm walks away with your upside. It purely depends on your technological capability.
That naturally brings us to slide 10, the ultimate wild card in this briefing. This section builds incredible dramatic tension around something called the sovereign alpha gap. It argues that market timing is no longer just about analyzing sentiment or cash flows. It is now inextricably bound to geopolitical sovereignty. We are looking at an index-wide single point of failure.
The analysis of the risk here is severe, and it is completely unhedged. The briefing focuses on the compute divide. We have massive revenue and infrastructural concentration in a tiny handful of firms, specifically NVIDIA and Taiwan Semiconductor Manufacturing Company, or TSMC.
Right.
The entire AI revolution, and by extension the algorithmic foundation of modern market mechanics, rests on their physical hardware.
And the briefing points out that a kinetic event in the Taiwan Strait would instantly turn the entire magnificent 7-stock concentration into a single geopolitical trade.
We are talking about a theater of kinetic financial warfare. The briefing makes it clear that we're dealing with forces entirely outside the scope of historical financial data. Absolutely no. Large language model, no matter how sophisticated its reinforcement learning is, can predict a sudden military or geopolitical supply chain disruption of that magnitude.
Because it's a completely unprecedented physical event.
Exactly. It is the ultimate blank spot. An AI only knows how to optimize based on past patterns. It cannot calculate the impact of an aircraft carrier group altering course in the Pacific.
So how do we operate in an environment where time has collapsed, models are triggering flash crashes, and the entire system rests on a geopolitical fault line? The briefing pivots hard into actionable strategy here on slide 11. The first strategy is the barbell plus circuit breaker architecture.
And the foundation of this strategy requires a massive commitment to reality over algorithms. The first mandate is allocating 85 to 90% of your portfolio to low-cost, fundamentally anchored positions.
We're talking about wide moat firms, companies with a return on invested capital to weighted average cost of capital ratio greater than 2.0.
Yes.
Let's do a quick translation on that acronym, SOUP, ROIC to WACC greater than 2.0.
Yeah.
Basically, you want companies that are making significantly more cash from their operations than it costs them to borrow money.
That is exactly correct. You want undeniable intrinsic value. You also anchor with treasuries and physical gold. You need assets that hold value regardless of what a panicked AI order book says in a 60-second window.
But here is the major rule change, and the briefing issues this as a direct command to the listener. Systematically abandon static stop-loss orders immediately.
Immediately.
Wait, abandon stop-losses entirely. That goes against literally everything Financial Planning 101 teaches you. You're telling me my safety net is actually a target on my back.
I cannot emphasize this enough. Static stop losses are actively hunted. They are triggered by AI algorithms during flash events.
How does that work?
If you have a stop loss set at 10% below the current price, the predatory models will sense the liquidity cluster. They will intentionally push the price down to trigger your sale, harvest your asset at a discount, and ride the price back up.
So if you abandon your safety net, how do you protect the portfolio?
You allocate the remaining 10 to 15% of your portfolio strictly to convex tail risk instruments. We are talking about long-dated, out-of-the-money puts on concentrated indices and VIX calls.
In plain English, you buy active insurance against systemic failure, rather than relying on a static price trigger that will be weaponized against you.
Precisely.
The second strategy on slide 12 moves from architecture to tactical execution, correlation timing, and fundamental arbitrage. The briefing gets highly specific here. It says to deleverage entirely if the correlation between the Magnificent Seven and the broader index spikes above 0.90 within a 15-minute window.
This is the defensive use of data. A correlation spike above 0.90 across diverse sectors in just 15 minutes means fundamentals have been abandoned.
It's pure panic.
Right. It means the algorithms have taken over and are aggressively liquidating everything indiscriminately to raise cash. That is your signal to step back, because a systemic event is in progress.
But the briefing also explains how to weaponize AI panic. When an AI misinterprets a headline, maybe a news-gripping bot misunderstands a geopolitical statement, and drops a firm 20% in minutes, you step in.
You buy on the non-economic news.
The strategy here is to set good-till-canceled limit orders, 15 to 20% below the intrinsic value of those wide-moat companies.
It is a brilliant way to automate your ability to capitalize on forced algorithmic selling. You are essentially casting a net at the bottom of the ocean to catch the flash crashes. Furthermore, the briefing advises swapping those static stops for AI-driven exits that actively monitor order book slippage risk. You must adapt your exit strategy dynamically to the actual depth of the market.
Finally, we have the third strategy on slide 13, infrastructure redundancy and analog hedging. This is about hedging the shatter point. The mandate is to maintain a permanent 3 to 5% allocation to analog volatility hedges, specifically physical gold and non-aligned sovereign debt.
The absolute necessity here is mechanical decoupling. The briefing stresses that these analog hedges must be entirely isolated from the high-frequency grid.
Because if the grid goes down,
If there is a kinetic supply chain disruption like the geopolitical wildcard we discussed, the digital order books might freeze or behave entirely irrationally. You need assets that exist outside of the algorithmic ecosystem.
the briefing also has a stark directive for active traders. Shift 15% of your alpha budget away from pure strategy and spend it on sheer infrastructure. We are talking about physical advantages, co-location, private fiber, dedicated power supplies.
If you are going to play in the microsecond arena, you have to pay for the physics to support it. If your data takes 3 extra milliseconds to travel to the exchange because you're using standard infrastructure, your brilliant trading strategy is worthless. You will simply be the liquidity for the firm that paid for private fiber.
That brings us to the bottom line of this entire intelligence briefing on our final slide. The ultimate alpha in the modern era belongs to the investor who builds a portfolio robust enough to survive the speed of ruin. You have to be able to weather the top 10 minutes of chaos to see long-term compounding.
And that leaves you with a final thought to ponder based on the briefing we've just unpacked. We talked extensively about AI hunting human safety nets and the mechanics of a flash crash. But consider the end game.
Right.
What happens in 5 or 10 years when the human retail money is largely flushed out of these high-frequency skirmishes? When predatory AI models have no one left to hunt but other predatory AI models? Are we looking at a future where the stock market is just a closed-loop machine ecosystem entirely divorced from human economics and fundamental reality?
This is the research desk officially signing off.